You think your bank deposits are safe. You think FDIC will protect you. But a law passed in 2010 allows banks to bail themselves out using your deposits, and most Americans have no clue it exists. You need to understand this. The money in your bank account legally doesn't belong to you. The moment you deposit it, it becomes the bank's asset. You become an unsecured creditor. You're lending money to the bank. Your deposit is a loan to the bank, and any loan carries risk. Cyprus 2013 was the bloody lesson. What's about to happen in America already played out in Cyprus. In March 2013, Cypriot banks were on the verge of collapse. Instead of using taxpayer money for a bailout, the government tried a bail-in. On Friday, banks were operating normally. Over the weekend, the government announced new rules. When banks reopened Tuesday, anyone with over 100,000 euros in their account lost 47.5% of everything above that threshold. If you had 200,000 euros on Friday, by Tuesday you had 150,500. The bank took 47,500. No warning, no choice, no negotiation. Completely legal. This is a bail-in. Banks save themselves using depositor money. Your deposits get used to recapitalize the failing bank. People's life savings vanished overnight. Businesses couldn't make payroll. Retirees lost their pensions. You might be thinking, can't happen in America. But America already has the legal framework for bail-ins. The 2010 Dodd-Frank Act created it. After the 2008 financial crisis, Congress responded to public anger about using taxpayer money to save banks by creating a new system. Instead of bailouts, bail-ins. The bank's creditors and depositors foot the bill. The problem, when a bank fails, who are the creditors? You are. The specific mechanism is called Orderly Liquidation Authority. It gives FDIC the power to take over failing banks and restructure them. Restructuring can include converting deposits into bank equity. In plain English, they take your cash deposits and give you stock in the failing bank. Your money disappears from your account, and you become a shareholder in a collapsing bank. What's sickening? They don't need your consent, no permission, no court order required. During a crisis, FDIC has authority to execute this unilaterally. FDIC insurance covers up to $250,000 per depositor per bank. If you've got less than $250,000 in an account, theoretically you're protected. But here's the truth. The FDIC insurance fund has roughly $128 billion, while total U.S. bank deposits exceed $18 trillion. The FDIC fund covers less than 1% of total deposits. In a systemic banking crisis where multiple major banks fail simultaneously, the FDIC fund runs dry almost immediately. There's simply not enough money to cover everyone. Then what? FDIC has to borrow from Treasury. Either way, there's a delay. You might wait weeks or months. If they print money, inflation destroys its value. But more likely, they'll use bail-ins for massive failures. Faster, doesn't require congressional approval, doesn't add to national debt. The legal authority to execute it already exists. Imagine 2026. Commercial real estate crisis triggers massive bank failures. Over one weekend, FDIC invokes Orderly Liquidation Authority to restructure failing banks. Large depositors with excess over the FDIC limit get those deposits converted to equity. Monday, banks reopen. If you had $100,000, you still have $100,000. But if you had $500,000, now your account shows $250,000 plus stock worth maybe $100,000. You lost $150,000 overnight, completely legal. You agreed to this when you opened the account. Buried in the terms and conditions is language saying the bank can do this during a crisis. Business accounts are especially vulnerable. Most business operating accounts exceed $250,000. Payroll, vendor payments, operating expenses. A bail-in would destroy them overnight. Wealthy individuals with accounts exceeding FDIC limits are also targets. Even retirement accounts might not be safe. This isn't conspiracy theory. It's documented fact. In 2012, the FDIC and Bank of England jointly published a paper explicitly discussing using bail-ins as the primary tool for resolving failing banks. In 2013, the Financial Stability Board, which includes Fed and Treasury representatives, issued guidelines recommending bail-ins as the standard approach. In 2015, FDIC released bail-in procedure guidelines. Every major U.S. bank has a living will on file with FDIC detailing how they'd be liquidated in a crisis. All include bail-in provisions. This is all public information, but nobody talks about it. Media doesn't report it. Banks don't advertise it. So most people don't know this framework exists. But it does exist, and it will be used next crisis. Multiple crises are converging. Between now and 2026, over $1 trillion in commercial real estate loans mature. These loans were made when rates were near zero. Now rates are triple that, and occupancy is down 30 to 50%. Owners can't refinance at new rates. Buildings aren't generating enough income to service debt. Defaults are inevitable. Dozens, maybe hundreds of regional banks holding these loans will face massive losses. They're going to fail. Silicon Valley Bank collapsed in under 48 hours in 2023. $42 billion withdrawn in one day. That was one bank. Imagine 50 or 100 banks simultaneously in 2026. FDIC won't have time for traditional takeovers. The insurance fund won't have enough money. They'll have to use bail-ins. Residential mortgages, credit cards, auto loans, student loans, defaults are all rising. Derivatives risk is enormous. Banks hold hundreds of billions in derivative contracts tied to interest rates and real estate values. FDIC knows all this. They see the crisis forming, know a wave of bank failures is coming. That's why they've been quietly preparing bail-in procedures. First, understand your exposure. How much money do you have in bank accounts? Does it exceed the $250,000 FDIC limit per bank? If so, the excess is at risk for bail-ins. Second, spread deposits. If you've got $500,000, put $250,000 at one bank, $250,000 at another. Make sure they're truly different institutions. Third, move money out of banks. Direct ownership of Treasury securities is safer. Buy Treasury bonds through treasurydirect.gov, backed by the full faith and credit of the U.S. government. Treasury money market funds are another option, available through any brokerage, not subject to bail-ins. Fourth, reduce cash holdings. Cash is vulnerable to both bail-ins and inflation. Gold and silver are physical assets that can't be bailed in. They're not inside the banking system. During a banking crisis, precious metals hold value while bank deposits face risk. Real estate can't be seized in a bail-in. It's a real asset with intrinsic value. Stocks are also outside the banking system. Stocks held in brokerage accounts aren't subject to bail-ins. Fifth, critical for business owners. Business accounts probably hold significant operating cash, extremely vulnerable to bail-ins. Keep only what you need for immediate operations in business bank accounts. Move excess cash into Treasury securities or money market funds. Sixth, watch for warning signs. Bank stocks crashing, bank credit default swaps spiking, news reports about specific institutions having problems. When you see these, act fast. Move money out of vulnerable banks immediately. The Cyprus bail-in happened over one weekend. By the time people realized what was happening, it was too late. Speed matters in a banking crisis. People who get their money out first are fine. People who wait get caught. Seventh, understand there might be restrictions. During a banking crisis, governments might impose capital controls, withdrawal limits, temporary bank closures, transfer restrictions. That's why you need to act before the crisis. After the Cyprus bail-in, capital controls were imposed. People couldn't move money out of the country. It took months to return to normal. That could happen here. Eighth, don't assume your bank is safe. Even if your bank looks healthy today, that can change rapidly. Silicon Valley Bank looked fine. 3 days later, it was gone. In systemic crises, even healthy banks can get caught up in the panic. Bail-ins aren't just an American thing. G20 nations agreed in 2014 to adopt bail-in frameworks as the global standard. Europe has them. Canada has them. Australia has them. The same risk exists everywhere. The only real protection is moving money completely out of the banking system into assets that can't be bailed in. Physical gold, real estate, stocks, Treasury securities. Why won't politicians stop this? Because the alternative is worse. If you ban bail-ins, failing banks must be bailed out with taxpayer money. After 2008, there's massive public opposition to bank bailouts. Bail-ins solve that problem. Banks save themselves using depositor money instead of taxpayer money. Politically easier, even though it's devastating for people who lose deposits. Most politicians don't understand the details. Bail-in provisions were buried in technical language. Plus, many politicians have their wealth in assets, not cash. They're not vulnerable to bail-ins. You can't count on the political system to protect you. Protection is your responsibility. The government won't save you. Action 1. Calculate your total bank deposits. Action 2. Identify which accounts exceed $250,000. Action 3. Open accounts at other institutions. Spread deposits so no single bank exceeds $250,000. Action 4. Open a Treasury Direct account. Start moving excess cash into Treasury securities. Action 5. Open a brokerage account. Set up Treasury money market funds. Action 6. If you run a business, audit business accounts. Move excess amounts into Treasury securities or money market funds. Action 7. Buy some physical gold or silver. Insurance that can't be bailed in. Action 8. Talk to family members with large deposits. Help them protect their money. Action 9. Review retirement accounts. If at banks, consider moving to brokerages. Action 10. Set up account alerts so any unusual activity notifies you immediately. Do these 10 things this week, not next month. Crisis is coming. You don't have unlimited time to prepare. Based on the commercial real estate crisis, stress on bank balance sheets, and loan maturity timelines, late 2026 or early 2027 is the critical window. That gives you roughly 12 to 18 months to prepare. Don't wait until the last minute. The people who get caught in bail-ins are the people who ignored warnings, who thought it couldn't happen here, who trusted that someone would protect them. Don't be those people. Be the person who saw the risk and took action. The person who protected their family and wealth. The person who was prepared. If this article opened your eyes to bail-in risk, share it with everyone you know. Your family, friends, and business partners all need to know. Whatever you do, don't keep more money in banks than you can afford to lose.